Hey everyone, and welcome. Get ready to dive deep, like really deep into the world of venture capital. We're talking about those intriguing Wharton Business School course materials you sent over. This stuff is seriously good. We've got course overviews, industry analyses, even deep dives into value and really interesting stuff. But let's be real for a sec. Academic jargon can be a total snooze fest, right? So today, consider us your trusty translators. We're cutting through the noise to uncover the good stuff, those aha moments that'll make you sound like a VC pro. First up, we're tackling those pesky VC myths that just refuse to die. You know, the ones that make you think every VC investment is a one-way ticket to unicorn land, overflowing with billion-dollar exits. Yeah, our first document, MGMT 8040 2024 Module 1 Introduction and the VC Industry Today as of August 28, 2024, is about to burst that bubble. Get ready for some myth busting. Myth number one, and it's a big one. Venture capital guarantees spectacular returns. It's like an exclusive club where everyone's swimming in cash, right?
Well, not exactly. Sure, you hear about those headline-grabbing success stories, the companies that go public and make everyone involved filthy rich. But the reality is, well, a lot less glamorous.
This module actually compares the 10-year returns of the U.S. Venture Capital Index to the NASDAQ and S&P 500. And guess what? The results might surprise you.
It's kind of like playing the lottery. Everyone focuses on the jackpot winners, right? But nobody talks about the millions of people who bought tickets and won absolutely nothing. Those massive exits, your Snapchats, your Ubers, they skew the picture. For every fairy tale ending, there are countless flops that never see the light of day.
So this idea of VC guaranteeing spectacular returns, that's just not the whole picture.
It's a classic case of survivorship bias.
Yeah.
People see the winners and assume that's the norm. But the reality is far more nuanced and, frankly, a lot riskier.
Myth busted. Okay, ready for myth number two? Here it comes. Venture capital is a massive industry. We're talking Wall Street titans throwing money at anything that even whispers the word startup, right? Well, our trusty module throws a bit of cold water on that image. It actually says that compared to the U.S. stock market, which is worth something like $30 trillion, VC is actually a pretty small pond.
Right. And within that smaller pond, the competition is fierce. Think about it. Only a tiny percentage of startups actually get VC funding. We're talking like 1 to 2% of those who even try.
Wow. That is incredibly selective. Makes you wonder what separates the chosen few from the rest.
It's definitely not just about having a cool idea. You need a rock-solid business plan, a team that can execute, a deep understanding of the market you're trying to crack. And even then, let's be honest, a little luck never hurts.
All right, last myth we're busting before we move on. And this one might sound pretty logical on the surface. Venture capital is the primary source of funding for small companies. Makes sense, right? Small businesses need money to grow. VCs have money to invest. Seems like a perfect match. But, and you probably saw this coming, this module throws a bit of a wrench in that idea. It turns out most small businesses, especially in those early stages, don't actually rely on VC funding at all.
Nope. There are plenty of other ways to get the capital you need, like bootstrapping,
Yeah.
tapping into those angel investors we've all heard about, even crowdfunding, and good old-fashioned bank loans are still a thing.
So the takeaway here, VC isn't the be-all, end-all for small businesses. In fact, it might not even be the right fit for every company. It really depends on your specific goals and needs.
Okay, now that we've cleared the air and busted those myths, let's peek behind the curtain and see what a venture capital firm actually does. And luckily for us, this module gives us a handy-dandy visual, a generic value chain, to break it all down.
It's like a roadmap. From raising the money they invest in the first place to finding those promising startups, then doing their due diligence to make sure they're legit. And if everything checks out, it's on to structuring the deal, providing ongoing support to those portfolio companies, hopefully guiding them to a successful exit down the road.
I'm a sucker for a good visual. This funnel diagram really caught my eye. It illustrates the VC financing process. And let's just say it's a pretty narrow funnel. It has to be, honestly. VCs get bombarded with pitches. I mean, flooded with proposals from hopeful entrepreneurs. They have to be incredibly selective if they want to find those potential winners.
Can you imagine the emails, the pitch decks, the sheer volume of ideas they have to sift through? It's mind-boggling. No wonder only a tiny fraction actually get funded.
It's a constant process of evaluation, assessing risk, weighing potential rewards, making those tough decisions about where to place their bets.
Yeah.
And it's not just about the idea itself, you know? A lot rides on the team behind the idea. Do they have the experience, the drive, the ability to execute? Is the business plan sound? Is there a clear path to, actually making money? Those are the million-dollar questions.
Okay, but here's where things get really interesting. This module talks about this virtuous circle of VC success, and it all hinges on a firm's reputation.
Oh, reputation is everything in this business. It's like social currency. If you've got a proven track record of picking winners, of guiding startups to success, well, that attracts more winners. It's like a self-fulfilling prophecy.
So it's not just about having money to throw around. It's about building a brand, a legacy of success that makes you stand out in a sea of investors.
You got it. And that brand, that reputation, it's built on those big wins, on nurturing promising startups, on generating those eye-popping returns that make investors eager to jump on board.
Right. So we've debunked some common VC myths, peeked into their world, explored their processes, even touched on the power of reputation. But now, let's get into one of the most mysterious and often misunderstood aspects of VC valuation. Our next document, MGMT 8040 2024 Module 3 Valuation Methodologies as of August 16, 2024, promises to shed some light on this enigmatic process. Get ready, because it's about to get real. Because honestly, isn't valuing a startup kind of like trying to predict the future? So much potential, but also a whole lot of unknowns.
You hit the nail on the head. It's not like valuing an established company with years of financial data to go on. With startups, you're dealing with a lot more what-ifs than certainties. It's as much an art as it is a science, that's for sure.
Okay, so where do you even begin? How do you slap a price tag on something as unpredictable as a startup?
Well, this module lays out 3 fundamental things to keep in mind. First, market forces, supply and demand, investor appetite, even the overall economic climate all play a role. Second, there's a lot of information asymmetry in the startup world. Founders often have this deep understanding of their technology, their market, their vision. And investors, they're constantly trying to fill in the gaps, assess the true potential, figure out if this thing is the real deal or just hype.
So it's like a high-stakes poker game, everyone holding their cards close to their chest?
Exactly. And third, we can't forget about risk. Investing in startups is inherently risky, especially in those early stages. Things can change on a dime.
This module actually has a pretty sobering graph showing the return distribution of VC firms' investment. Let me tell you, it really highlights the unpredictable nature of the beast. You've got those home runs, the ones that make everyone rich. But then you've got the more common scenarios, the failures, the mediocre performers that barely break even.
Yeah, it's a good reminder that not every promising pitch will turn into the next Facebook or Amazon.
All right, so with those realities in mind, let's talk about how VCs actually try to put a number on these fledgling companies. This module goes into detail about a few different valuation methods. We've got the comparable method, the discounted cash flow method, a DCF for those in the know, and then there's the venture capital method. Each has its pros and cons, its quirks and complexities.
And let me tell you, choosing the right method or combination of methods can have a big impact on the final valuation. It's not as simple as picking a number out of a hat.
Definitely not. Okay, let's start with the comparable method. Sounds pretty straightforward, right? Find similar companies, see what they're worth, and boom, you've got a benchmark.
Sounds easy in theory, but in practice, it's a bit trickier than that. Finding truly comparable companies, especially in those newer industries that are constantly evolving, can be like finding a needle in a haystack.
And even if you manage to find a few decent comparisons, there's still the issue of accounting for the specific stage of the startup, how far along they are, the risks involved, their potential for growth.
Exactly. It's not a one-size-fits-all kind of deal.
Right. Okay, so maybe not as simple as it first appears. What about this discounted cash flow method? I'll be honest, that one always sounded a bit intimidating.
There's a bit daunting, yeah. But essentially, the DCF method is all about projecting a company's future cash flow, how much money they're expected to make down the line. And then you adjust those future earnings based on their present value.
So you're basically trying to predict the future of a company, which, as we've established, is no easy feat, especially when you're dealing with startups that are still finding their footing.
Right. You're trying to estimate how much cash the company will generate in the years to come, and then discounting those future dollars based on the time value of money, the idea that a dollar today is worth more than a dollar tomorrow. Makes sense when you think about it.
And of course, the riskier those future earnings, the less those future dollars are worth today.
Precisely. But here's the catch, and this module does a good job of highlighting this. Applying the DCF method to startups can be really challenging.
For starters, projecting the future cash flow of a company that's still in its infancy, it's more like educated guesswork than an exact science.
Exactly. And on top of that, you've got the challenge of figuring out the appropriate discount rate. What rate accurately reflects the risk of investing in a particular startup? There's no easy answer.
So we've got the comparable method, which can be tricky, and the DCF method, which has its own set of challenges. That brings us to the venture capital method. What's the deal with this one?
This one's interesting because it was practically made for VC investing. It takes into account the unique circumstances of betting on early-stage companies.
This module actually calls it a method commonly used in the venture capital community. It's like their secret weapon for making sense of the chaos.
You could say that. One of the cool things about the venture capital method is that it relies less on traditional financial metrics. And that's a good thing when you're dealing with startups that might not even be generating revenue yet.
This module uses a great example: Snapchat's 2013 funding round. Apparently, institutional venture partners, or IVP, invested $80 million based on a pre-money valuation of $800 million. Can you walk us through that?
Sure, that's a classic example of how VCs think. They start with their desired return, how much they want to make on their investment, and work backward from there. They factor in things like anticipated dilution and the expected exit timeline to figure out what future valuation would justify their investment today.
So in Snapchat's case, IVP, assuming they wanted a 60% annual return and an IPO by, say, 2018, would have needed Snapchat to be valued at something like $15 billion at IPO to hit their target.
Crazy, right?
Yeah. Then they'd compare that target valuation to the IPO valuations of similar internet companies to see if it was even in the realm of possibility.
It's fascinating how much of VC seems to revolve around anticipating future outcomes, placing bets on potential rather than what's already there.
That's the name of the game. And that's what makes the venture capital method so well suited for this world. It embraces the uncertainty, the possibility of massive payoffs, but also the very real chance of striking out.
This module breaks down the method into a series of steps. First, they have to estimate the company's terminal value, basically what they think it'll be worth when they exit the investment, usually through an IPO or an acquisition. And to figure that out, they often rely on, you guessed it, the comparable method. They look at similar companies, how they performed, to get a ballpark figure.
But as we've already discussed, finding those truly comparable companies, especially for innovative early-stage startups, can be like trying to herd cats.
Exactly. It's one of the inherent challenges of the venture capital method. It relies on a lot of assumptions about the future, which is inherently uncertain.
Okay, so they've done their best to estimate the terminal value. What happens next?
Well, then they discount that future value back to the present, much like in the DCF method, but using a target rate of return that reflects the higher risk and potentially higher reward of VC investing.
And that target rate of return is typically much higher than your average investment, right?
Oh, absolutely. We're talking 30, 40%, sometimes even higher. They need those outsized returns to make up for the fact that many of their investments just won't pan out.
They're basically pricing in the very real possibility of failure.
That's the game they're playing. High risk, high reward.
Makes sense. Now, this module also emphasizes the importance of something called sensitivity analyses. That's like running different scenarios to see how changes to key assumptions might affect the valuation.
Sensitivity analyses are huge because they force investors to confront the uncertainty of VC head-on. It's about considering a range of possible outcomes, not just the rosy scenario.
So you've estimated the terminal value, discounted it back to the present, and run your sensitivity analyses. What's next? Is that when the deal is done?
Not quite. That's when the real negotiation begins, figuring out the ownership stake the VC will get in exchange for their investment. And that's where things can get really interesting.
Because that's where dilution comes into play, right?
Exactly. Every time a company raises more money, the ownership stake of the existing shareholders gets diluted.
So if a company issues new shares in a later funding round, the percentage ownership of those early investors decreases, even if they don't sell any of their existing shares.
That's right. Their piece of the pie shrinks, even if the overall pie is getting bigger.
This module uses a fictional company called Microelectronics Corp. To illustrate this. It shows how a VC would calculate how many shares they'd need to own in each round to reach their target ownership percentage at exit.
It's a great way to visualize how VCs think about ownership and dilution over the lifetime of an investment, because they're playing the long game here.
It's a lot to wrap your head around, that's for sure, but I think we're starting to get a handle on this whole valuation thing.
It's complex, no doubt, but understanding these concepts is crucial for both founders and investors. It's about making informed decisions, structuring deals that make sense, and setting everyone up for success.
Okay, we've covered a ton of ground on valuation, but before we get completely lost in spreadsheets and financial models, let's shift gears and talk about what happens after the valuation is agreed upon. That's when the real fun begins, term sheet time. All right, so we've navigated the wild world of startup valuation, got a taste of the complexities, the what ifs, the whole nine yards. But now it's time to get down to brass tacks, to dive into the trenches of term sheet negotiation. This is where the rubber meets the road, where founders and VCs hammer out the nitty-gritty details of their agreement. And our guide for this expedition, MGMT 8040 2024 Module 4, Negotiating the Preferred Stock Term Sheet as of September 26, 2024. This document describes the term sheet as a letter of intent, basically outlining the key financial and legal terms of the investment. Think of it like the blueprint for the entire relationship between the startup and the VC.
That's a great analogy. It lays the foundation for everything that follows.
And while the VC usually drafts the initial term sheet, this module stresses that it's not a take it or leave it kind of deal. There's room for negotiation for both sides to make sure their interests are represented.
Absolutely. The term sheet should be a starting point, a springboard for a collaborative discussion. Both sides need to work together to find terms that make sense, terms that benefit everyone involved.
So it's less of a battlefield, more of a partnership.
Exactly, a partnership where everyone's working towards a common goal.
I like the sound of that. Now, this module highlights a few key things to consider before diving into the specifics of a term sheet. And it all starts with research, really understanding the VC firm you're dealing with.
Due diligence is crucial. Not all VCs are created equal. They have different reputations, different investment styles, different areas of expertise.
It's like choosing a business partner, not just a source of funding, right?
100%. You want to make sure your values align, that their approach to supporting portfolio companies meshes with your vision and your needs.
This module also encourages founders to understand the VC's business model. It talks about a few different models, like the traditional model, the agency model, even this intriguing community model. What's the difference?
It's about how involved they are in the day-to-day operations of the companies they invest in. Some VCs are very hands-off. They provide capital and maybe some high-level guidance, but they let the founders call the shots. Then you've got VCs who take a more active role. They're in the trenches, offering operational support, connecting founders with their network, maybe even helping with things like hiring.
So it's about choosing the level of involvement you're comfortable with. Some founders thrive with a hands-on VC, while others prefer more autonomy.
It's all about finding the right fit for your company's culture, its stage of development, and your own personal leadership style.
And here's a golden nugget of advice from the module. Always try to get multiple bids from different VCs. Why is that so important?
Competition, my friend. Competition breeds better terms. When VCs know they're competing for a deal, they're more likely to put their best foot forward, both in terms of valuation and those other crucial terms we'll get into.
So it's about creating a bit of a bidding war for your startup.
You could say that, but it's not just about driving up the price. It's about having options, being in a position to choose the investor and the deal terms that align best with your long-term vision.
Makes sense. This module also stresses the importance of understanding valuation trade-offs. Can you elaborate on that?
Of course, it's tempting to fixate on getting the highest valuation possible. But here's the thing. Pushing for a higher valuation might mean making concessions on other terms, and vice versa. It's all interconnected.
It's a delicate balancing act, like trying to juggle chainsaws while riding a unicycle.
That's one way to put it. Founders and investors need to be strategic, thinking several steps ahead, anticipating how different terms might play out in various scenarios.
It's like a game of chess where every move has consequences.
You got it. And like chess, having a sound strategy is key.
Okay, so we've talked about the importance of researching VCs, understanding their business models, seeking multiple bids, and being mindful of those valuation trade-offs. Now, let's roll up our sleeves and get into the nitty-gritty of the term sheet itself. This module highlights a few key terms that deserve careful consideration. Valuation, of course, but also control, liquidation preference, and anti-dilution provisions. Let's tackle them one by one, shall we? We've already spent a good chunk of time talking about valuation, but from a term sheet perspective, what are some things founders should keep in mind when negotiating this crucial term with VCs?
Preparation is paramount. Founders need to know their company inside and out. The value proposition, the market opportunity, the financials, everything. VCs are valuation experts, so you need to be able to justify your numbers.
It's like going into a salary negotiation. You wouldn't just throw out a random number. You'd do your research, understand your market value, and come prepared to back up your ask.
Exactly. And don't be afraid to push back if you genuinely believe the VC's valuation is undervaluing your company. But, and this is important, be realistic. A sky-high valuation might sound great on paper, but it can create problems down the road if you can't deliver on those lofty expectations.
It's about finding that sweet spot, a valuation that's both attractive to investors and achievable for the company.
You nailed it. It's about setting everyone up for success, not creating unnecessary pressure.
Okay, valuation check. Next up, control. This module dives into the various mechanisms VCs use to exert control over a company, even if they don't have a majority ownership stake. We're talking board seats, protective covenants, even something called drag-along rights. Can you break it down for us?
Sure, control is a major sticking point in any VC deal. It's about finding that balance between giving founders the freedom to execute their vision and giving investors a say in how their money is being used. It's all about balancing risk and reward.
It sounds like a delicate dance, especially when you've got multiple parties with different priorities and, let's be honest, different levels of risk tolerance.
It definitely requires finesse. That's why it's crucial to understand the different levers of control and how they can impact a company's trajectory.
This module draws a distinction between statutory control, which is based on a company's governing documents and the law, and contractual control, which stems from the agreements outlined in the term sheet and other investment documents. What's the difference?
Statutory control usually governs major corporate actions like mergers or acquisitions, stuff that requires a shareholder vote. Contractual control, on the other hand, gives investors more influence over day-to-day operations or specific business decisions. It's about having a voice in how the company is run.
It sounds like VCs have a few different tools in their toolbox when it comes to exercising control, and this module mentions board seats as being particularly valuable.
Oh, board seats are highly coveted. They give VCs a direct line to shaping a company's strategy, approving budgets, even weighing in on hiring decisions. It's about having skin in the game, a seat at the table where those big decisions are made.
And the number of board seats allocated to VCs is often tied to the size of their investment, right? The more money they put in, the more say they get.
Generally speaking, yes, but it's not always about the numbers. The experience and expertise of the VC representatives on the board can be invaluable to a young company trying to navigate uncharted territory.
So it's about striking that balance, leveraging the VC's experience and guidance without stifling the founder's vision or hindering their ability to lead.
Precisely. When done right, having VCs on the board should be an asset to the company, not a source of friction or micromanagement.
Okay, let's move on to another term that often causes confusion. Liquidation preference. This sounds like it dictates how the spoils are divided if the company gets acquired or goes belly up.
That's the gist of it. Liquidation preference determines who gets paid first and how much when a company is sold or liquidates its assets. It's essentially a way for investors to protect their investment if things go south.
So, worst case scenario. The company goes under investors with a liquidation preference, get their money back before other shareholders, even if there's not enough to go around.
That's the general idea. It's a way to incentivize investment, especially in those early stages when the company is considered high risk.
Makes sense. This module gets into the weeds of different types of liquidation preferences, and I have to admit, this is where it gets a bit hairy for me. We've got participating preferred, non-participating preferred, even something called capped participating preferred. Help me out here.
Okay, think of it this way. Imagine you and your friends pool your money to buy a lottery ticket. You all agree that if you win, you'll split the winnings based on how much each person contributed.
Right, so far so good.
Now imagine one of your friends is a bit risk-averse. They say, hey, I'm only in if I'm guaranteed to get my money back, even if we only win a small amount. That's kind of like a liquidation preference.
Okay, I see where you're going with this. So participating preferred is like that risk-averse friend who wants their money back plus their share of any remaining winnings. They want it all.
You got it. They get the best of both worlds. Non-participating preferred is more like saying, I'll take my initial investment back, and then I'll participate in the remaining winnings alongside everyone else. They're giving up a guaranteed return, but have the potential for a larger upside if the company really takes off.
And capped participating preferred, that sounds like a middle ground between the two.
Exactly. It's like saying, I'll take my initial investment back and then participate in the remaining winnings, but only up to a certain limit. It's a compromise.
This module uses a hypothetical company, High Tech Inc., to illustrate how these different liquidation preferences might play out in a sale. And let me tell you, the amount each shareholder receives can vary dramatically depending on the type of preference and the final sale price.
It's a perfect example of why understanding these nuances is so important, especially for founders who might not realize the implications until it's too late.
All right, moving on. We've covered valuation, control, and liquidation preference. That brings us to anti-dilution provisions. They sound pretty self-explanatory, protecting investors from having their ownership stake diluted in future funding rounds.
That's the gist of it. Imagine a company raises money at a $10 million valuation, and an investor buys 10% of the company for a cool million. Later on, the company needs more funding, but investors are only willing to value the company at $5 million. Now, if there were no anti-dilution provisions, that early investor stake would be worth a lot less, even though they haven't sold any of their shares. Their ownership percentage is the same, but the value of those shares has plummeted.
That hardly seems fair. They took a chance on the company early on, and now their investment is worth less just because the company needed more funding to grow.
That's the challenge, and that's where anti-dilution provisions come in. They aim to protect investors from that exact scenario, ensuring that their ownership stake is adjusted if the company raises money at a lower valuation in the future.
So it's a way to ensure that those early investors, the ones who took a chance on the company when it was still finding its footing, aren't unfairly penalized.
Exactly. It's about protecting those who took on more risk early in the game.
This module gets into the weeds of different types of anti-dilution provisions, including full ratchet and weighted average. Can you walk us through those?
Sure. Full ratchet anti-dilution is the most investor-friendly provision. Basically, if the company issues new shares at a lower price than what an investor initially paid, their ownership is adjusted as if they had invested at that lower price all along. They're covered no matter what.
So it's like a reset button for those early investors.
Exactly. Weighted average anti-dilution is a bit more balanced. It considers both the price and the number of shares issued in that down round, so the adjustment to the investor's ownership stake is less drastic. It's a bit more, shall we say, equitable?
This module emphasizes that anti-dilution provisions are often a major point of negotiation in term sheets, and it's easy to see why. They can have a huge impact on the ownership structure of the company, especially if there are multiple funding rounds with fluctuating valuations.
It's a complex area, and it's definitely one where having experienced legal counsel is invaluable. Both founders and investors need to understand the nuances of these provisions, the potential scenarios, and how those scenarios might impact the company's future.
We've covered a ton of ground in our deep dive into venture capital, from those seductive myths to the nail-biting reality of term sheet negotiations. But hold on tight, because we're about to explore the darker side of VC, where conflicts of interest can arise between founders and investors, sometimes with dramatic consequences. Our guide for this exploration is MGMT 8040 2024 Module 6 Corporate Governance as of September 21, 2024. And to really bring this home, we're going to dissect a case study that's become almost legendary in the startup world, Theranos. This module lays out the whole saga, starting with Elizabeth Holmes's vision of revolutionizing blood testing. It's a story ambition of a company that skyrocketed to fame with the help of hype, celebrity endorsements, and a board of directors stacked with some seriously heavy hitters. But then, well, the bottom fell out. Lawsuits, convictions, the whole 9 yards. Theranos became synonymous with corporate governance gone wrong.
It's a classic cautionary tale. It shows how blinding ambition, a compelling narrative, and the failure to ask tough questions can lead even seasoned veterans down a dangerous path.
This module actually includes a slide with the Theranos board of directors listed out. It's unbelievable, really. Former secretaries of state, retired military leaders, business icons, you name it, they were on that board. It's mind-boggling that a group with that much experience, that much supposed wisdom, could have missed or ignored the warning signs.
It's a stark reminder that even the smartest, most accomplished people can fall prey to hype, to charisma, or even just to groupthink. Nobody wants to be the lone voice of dissent in a room full of powerful people.
So how do we prevent these kinds of disasters from happening? This module keeps coming back to the importance of strong corporate governance, particularly the role of the board of directors and their fiduciary duty to the company and its shareholders.
Fiduciary duty is paramount. It means directors have a legal and ethical obligation to act in the best interests of the company and its owners, not to prioritize their own personal gain or agendas. It's about putting the company first.
This module breaks it down into a duty of loyalty, a duty of care, and a duty of oversight. So it's not just about avoiding conflicts of interest. It's about actively engaging, asking the hard questions, and holding management accountable for their actions.
Exactly. Directors can't just sit back and rubber stamp whatever the CEO puts in front of them. They need to be actively involved, scrutinizing decisions, challenging assumptions, making sure the company is being run responsibly and ethically.
Now, this module mentions something called the business judgment rule. It sounds like it gives directors some legal protection when they're making tough decisions, even if those decisions don't pan out in the end.
It does. The business judgment rule basically says that directors won't be held liable for honest mistakes in judgment as long as they acted in good faith, were informed about the situation, and genuinely believed their actions were in the best interests of the company.
So it's not about guaranteeing perfect outcomes every time, because let's be real, business is inherently risky. It's more about ensuring a sound decision-making process, even if the outcome is less than ideal.
Precisely. Directors shouldn't be paralyzed by the fear of making a mistake. They should feel empowered to take calculated risks, but those risks need to be well-informed, thought out, and aligned with the company's overall strategic goals.
But this module also makes it clear that the business judgment rule is not a free pass for reckless behavior. If directors are negligent, don't do their homework, or engage in self-dealing, they can and should be held accountable for their actions.
Absolutely. The business judgment rule protects directors who are acting in good faith, not those who are acting recklessly, unethically, or in their own self-interest. It's about accountability.
Speaking of ethical dilemmas, this module highlights some potential conflicts of interest that VC directors might face. For example, personal relationships with the founders, competing investments in other companies, even just the pressure to maintain their reputation within the VC community. It's a small world, right?
These situations can be tricky, no doubt. The key is transparency. If a director has a personal or financial interest that could potentially influence their judgment, they need to be upfront about it. Recuse themselves from those specific decisions, let someone else take the lead.
It's about putting the company's interests above all else, even if it means stepping back from a particular deal or decision. It's about integrity.
Couldn't have said it better myself.
Okay, so we've talked about the importance of fiduciary duty, the business judgment rule, the importance of navigating conflicts of interest. But theory is one thing, reality is another. We all know that conflicts do arise, and sometimes the consequences can be messy, to say the least. And that brings us to another case study from this module, the case of Atlantic Corp. It's a textbook example of the sometimes contentious relationship between founders and investors, especially when things don't go according to plan. This module provides a fascinating timeline of Atlantic's journey from its humble beginnings in 1987 to its eventual sale in 1996 for a staggering $776 million. But here's the twist. The founders, the very people who brought this company to life, ended up with a tiny, almost insignificant ownership stake by the time the dust settled. Less than 0.1%. It's unbelievable.
It's a cautionary tale for sure. It shows how founders can, intentionally or not, get squeezed out of their own creation, often through a series of funding rounds, dilutive events, and control provisions that shift the power dynamic in favor of investors.
It's a stark reminder that even in a seemingly successful exit, the distribution of those spoils isn't always fair or equitable. And those early-stage decisions about control, about equity, can have a ripple effect that lasts for years.
Absolutely. It underscores the importance of founders seeking legal advice early on, really understanding the long-term implications of those term sheet negotiations, and fighting for their interests every step of the way.
It's a lot to consider, but forewarned is forearmed, as they say. As we wrap up our deep dive into the world of venture capital, the myths, the realities, the opportunities, and yes, even the potential pitfalls, what are some key takeaways you want to leave our listeners with today?
Well, first and foremost, knowledge is power. The more you understand the inner workings of this world, the better equipped you'll be to navigate it successfully. Second, never underestimate the importance of relationships. Building strong, trusting relationships with investors, advisors, mentors is crucial. Venture capital is a people business, and having a network of trusted allies can make all the difference. And finally, don't be afraid to ask questions. Don't be afraid to push back, to challenge assumptions, and to seek out expert advice when you need it. There's no shame in admitting you don't know everything.
Those are words to live by, in the VC world and beyond. Thank you for joining us for this deep dive into the fascinating, complex, and at times treacherous world of venture capital. We hope you've gained some valuable insights that will serve you well on your own entrepreneurial journey.